Hi, I'm Seth Freuberg. I'm the Director of Options Trading here at SMBU in Manhattan. I'm also the head trader of SMB's Options Trading Desk. So today I'd like to talk about a situation that traders will get in often, which is that you're having a rough month and you're getting close to your stop or your maximum loss on a trade. And I had a situation like that recently with one of our traders, and we had a discussion about how to think about that situation properly. And the conclusion I reached was the title of today's video, which is, if you have to use your imagination to see how you win, it's time to close your trade. So let's talk about what I mean by that. I want to give you an example of a trade that has taken a lot of realized losses. Let's just say hypothetically this trade that you're looking at on the screen has a maximum loss or a stop of $15,000, and we're already at $13,005, halfway or so into the cycle. So the question you have to ask yourself when you're down that much money, and this is a trade that's was adjusted quite a bit and therefore took quite a number of realized losses. The question you need to ask yourself is, can I really get out of this thing? And traders by nature are optimists. They are always picturing themselves victorious, and that is sometimes a good trait and sometimes a bad trait. When you're down this much money, you really got to look at the realism of whether you have any realistic chance at all of not getting stopped. And so it's a little bit of a holistic discussion. You have to sort of look at the market, look at the charts, think about what's going on, think about big announcements or big economic events that are coming up, and the realisticness of there being big moves or not being big moves before you get stopped out of the trade. Because in our style of trading, a very large move oftentimes will force an exit, and oftentimes will force an exit somewhat beyond your stop. So when trades take lots of realized losses like this one, they will often look like this, which means you have very little room for error on this trade. So a measurement that I like to do to determine whether it's time to get out of a trade, whether I'm at my stop or not, is whether a 2 standard deviation move in either direction forces me out of the trade at my stop. And in this case, with a 2 standard deviation down move, we go a little bit past my stop. With a 2 standard deviation up move, we go quite a bit past my stop, which in this case is $15,000. So the question you have to ask yourself is it likely that such a move won't occur over a 1 or 2 day period? And if you're in a volatile time, if you're in a time with a high average true range, it's not going to be real likely that you're going to wiggle your way out of the trade. So when I get into this situation, I like to ask myself the following 3 questions, which is really essentially the same question asked in 3 different ways, but it helps you to frame it up in your mind. And the first question is it much easier to get stopped out on this trade than it is to win it? If it's much easier to get stopped out on it than to win it, just think about that a little bit. Let's go into the second question. Would only an unusual scenario allow me to win this trade? That would be another way of asking the question. A third way is, do I need to use my imagination to figure out a way for me to come out of this trade alive? If any of those questions are answered with a yes, it's time to get out of the trade. What it means is you're much more likely to get hurt, you're much more likely to lose more money, you're much more likely to hit your stop and maybe beyond than you are to have that unusual series of events occur that would allow you to win the trade. So why is this so important? This is an annual return game. Options income trading or market neutral positive theta options trading is an annual return game. If you can reduce your loss from 10% to 8% in a bad month, that's the same as making 8% on a trade versus 6% in a good month. So nobody would say I'd be less inclined to take an 8% gain than a 6% gain. Then why would you be any less inclined to take an 8% loss versus a 10% loss? So these little edges, such as getting out of a trade when it's inevitable you're going to get stopped out anyway, are the kinds of return savers that add up over a year and can turn a 30% annual return into a 35% annual return on your trading, for example, just simply by using your common sense and doing some simple common sense analysis, which isn't just statistical. Look at the market. Look at big announcements coming up. This last week was Brexit, okay? There had to be a big move regardless of the way the Brexit vote went. So if you're in a situation where a big move in either direction is going to stop you out of the trade, it's not real smart to be in the trade at that point. And that's why many of the traders on our desk started phasing out and getting flat right before the Brexit trade, because they recognized they had taken enough in the way of losses on their trades that it just was not salvageable. Why take that incremental loss which gets you to your stop or maybe beyond it when it is something that could be avoided through some simple analysis? So please think about that in your trading. Save yourself some money by not sitting there flat-footed, allowing yourself to get stopped out, which is a very, very likely scenario. Instead, save yourself some return for the year and help your options trading to improve. So I hope that is helpful. Let me know if you have any questions. You can send me an email at sfroyberg@smbcap.com. Thank you.